evening, everyone, and welcome to our webinar on the tax implications of the CARES Act today. I'm your host, Kavitha Baratakke from Cherry Street Investments. I'm very excited to have on our guest speaker today, Ted Lanzaro, who is a CPA, real estate investor. He's also a real estate broker, author, and speaker with over 29 years of real estate tax consulting and investing experience. Ted runs Lanzaro CPA LLC, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the past 29 years, he's helped thousands of real estate business owners, entrepreneurs, and investors all over the US implement cutting-edge tax strategies as to save them thousands of dollars annually on their taxes. Today, Ted is here to talk to us about the tax provisions of the CARES Act. The CARES Act, which stands for Coronavirus Aid, Relief, and Economic Securities Act, was passed by the Congress on March 7, 2020. A lot of you have heard about the different aspects of the CARES Act. You know, we talked about the SBA programs. We talked about the retirement changes with the CARES Act. And today we want to talk about the tax implications of the CARES Act. And so far, it's been about a $2 trillion economic relief package. And I've heard a lot of people saying there's more to come. So today we want to specifically understand the tax implications and how these tax changes in 2020 can benefit you. A quick disclaimer, of course, Ted is a CPA and he can give you advice, but he can't give you specific advice. So any advice he gives is general advice here. So for your specific tax situation, we also always recommend that you consult your own CPA. A few housekeeping rules. Please use the Q&A box in the Zoom application. Just makes it easy for me to track questions, especially if you have questions. If you have general comments or issues with audio, just use a chat box so we can keep chatting on there. This webinar will be recorded and I will send the link out to all the attendees within 24 hours. And please whitelist my email so it doesn't go to your spam folder. A quick note about some upcoming webinars. We have one more this week. It's 2 this week. So we have one on Sunday on Infinity Banking with Life Insurance on May 17th, Sunday at 5 p.m. Central. I hope you can join us. This is with Gary Pinkerton from Paradigm Life. And the registration link is bit.ly/infinitybanking. On Thursday, May 20th, we have a tax and asset protection strategies webinar with Toby Mathis from Anderson Legal and Business Advisors. Some future webinars that I want to keep you guys updated about. We have multifamily lending options and how lending has changed in the COVID environment with a large multifamily lender. I'll be announcing this in June. And estate planning, I know that with all the COVID changes, a lot more people are worried about planning their estate well. So that's something that has been top of the mind for me as well. So I'm getting an attorney to come talk about wills, trusts, and other plans that you should have in place for planning your estate. I'm also very interested in bringing mindset makeover with a large coaching company, which is very important for us as investors, as entrepreneurs, to really keep our mindset in the right place, especially through this crisis, and also look at these problems that we're going through as opportunities in the very near future. We also have some kids ongoing financial education that I conduct and my partner Anar is doing. So I do the teens webinars every Monday. If you have kids 11 to 18, please send them to my webinar. We've already done 8 sessions. We'll have 4 more. It'll be a 12-session financial education series. And all the recordings are on YouTube on Cherry Street Investments channel. So please get onto YouTube, have their kids watch it. And I hope they all learn from it because I know I've gotten a lot of great feedback from my kids so far. A lot of you know me, so I don't want to go through this whole spiel here. Just want to highlight that I do have a group called Purely Passive Investor Group on Facebook. And we do a lot of these webinars every week and sometimes every other week, depending on, I probably will go to every other week base so people don't have webinar fatigue. Also have a Cherry Street Investments YouTube channel with a lot of content if you're interested in real estate investment or any kind of financial education. So coming to our guest speaker today, I already introduced him briefly at the start. So he is a CPA and he runs his own CPA company. He's also the author of Tax Smart Landlord book and toolkit, and has written over 100 articles on taxation for the real estate industry, specifically for investors, landlords, flippers, and developers. So he has a lot of investment experience, real estate investment experience, just being a real estate investor himself, and of course, being a CPA. He is a sought after speaker and has spoken all over the US to groups of real estate investors and business owners on the taxation of real estate. So I'm extremely excited to present our guest speaker today. So over to Ted, and I'll stop sharing this so you can actually see him.
Thank you so much. It's so nice to be talking with everyone, and I really appreciate you having me on tonight. That was wonderful, and thank you for the introduction. That's really nice of you. I love what you're doing with kids. You know, that looks fabulous. I've got to get my kids on YouTube to take a look at that. I love that. That's awesome.
I'm happy to send you a link. Yeah, we've been having a good time. We do a lot of quizzes, and I give out some gift cards if they get things right. So that's really amped up the competitiveness of the kids. So it's been fun.
Yeah, no, that's fabulous. That's a great idea. So kudos to you for doing that. So I guess we could start with just some really basic kind of thought process, which is that as a result of the CARES Act, all of the tax deadlines were changed, right? So now business returns aren't due until June 15th, and personal returns aren't due till July 15th, and then both can be extended, the business returns extended to September 15th and the personals till October. But it gives everybody an opportunity, especially if you're going to owe money, gives everybody an opportunity to, hold on to your dollars for, a few more months. And for me, what's been the best part of it is gives me more time to really take a really good look at people's returns and literally try to find them every dollar of tax savings that I can, instead of, the kind of maybe rushed environment that we sometimes get the last couple of weeks, first couple of weeks of April, trying to get everything done by the April 15th deadline. So that extra time has, given us an opportunity to do a little more research, get to know our clients a little better, that sort of thing. The other side of that also has to do with 2020 estimated tax payments, right? So normally April 15th would have been the due date for your first quarter estimated tax payments. And here's what's happening with a lot of investors because of the pandemic and what's going on with rents, literally rent collection. A lot of people may not have the same income in 2020 that they might have had in 2019. Maybe it's a decrease in rents, maybe it's less business from your business because maybe your business is shut down, possibly, or has been decreased. So there's typically two ways that people make estimated tax payments. And the first way is based on 110% of your prior year's income. So you would not your prior year's income, your prior year's tax. So 110% of your prior year's tax. So if you paid $100,000 in taxes in 2019, you would make estimated payments of $110,000 in 2020. Now, the problem with that is if my income's down, I'm overpaying my taxes at this point. And I really don't want to do that, especially if business is bad or business is down and my cash flow is down. I don't want to give up that money. So the other way to do that, which is the more precise way, is to actually pay in 100% of what you owe for 2020 by literally looking at your accounting from January through March. How much money did I actually make January through March? and pay in the tax on those dollars, right? And then look at, okay, what did I make in April and May? Because the way the estimated tax payments work is you pay in April for January through March, you pay in June for April and May. So what did I actually make in April and May? And then I can pay in 100% of what I actually owe for 2020, which may be quite a bit less than 110% of my prior year's tax. Both of those payments right now are due on July 15th. So that gives you extra time to do that. And it gives you an opportunity to maybe make a lower estimated payment. I always tell people that good record keeping is really, really important for investors and business owners, right? So if you have really, really good record keeping, that's the foundation of all tax strategies. So all the strategies in my book, The Tax Smart Landlord, some of the things we'll talk about tonight, they're all based on having good records. To the extent you have good records, you'll be able to say, hey, look, Ted, here's my income from January through March. Here's my income from April and May. Now let's calculate the exact tax payment that I owe, not a dollar more, right? Also, to keep in mind that most great tax strategy happens during the year, not from January to April of the following year. So if you know what your income is during the year and you have good records, then we're able to position you with strategies during the year, right? So I always tell people, look, you want to call me when you're buying a property, when you're selling a property, when you're renovating a property, and then towards the end of the year. All of those actions, right? All of those things have a specific set of strategies that go with them. When you're doing them, you want to be looking at those strategies and taking advantage of those strategies and documenting those strategies. And I'll just give you a quick example. When you buy a property, it's possible to do a cost segregation study, right? On a big, say on a good sized property, $1 million or more purchase price. Now, if I'm buying that property, when I'm in the process of closing it, I'm thinking about all of those things, right? I'm thinking about, okay, well, I want to do a cost segregation study. That's going to get me some bonus depreciation. Am I going to be renovating when I buy? If I am, then there's a whole thought process that goes into that, right? And there's strategies that go into that. So I can deduct things that I abandoned from the renovation. So if I throw away, if I buy a 100-unit building and got all the kitchens, I literally can take a deduction for all of the items that were thrown into the dumpster during the renovation. So that's what I mean when I talk about good record keeping, the ability to track all of that stuff. What did I get rid of? What was my cost basis on the property? Just being able to keep a good P&L, for the property. And a lot of people use managers for that. That's great too. And typically, that's probably the best way to do it on the larger properties. On the smaller stuff, a lot of people do their own accounting, and that's what I'm talking about. You really want to be on top of that. So that's one thing. We're going to talk a little bit about the NOL carryback now. I wanted to check my notes. Sorry about that. So there's an opportunity as part of the CARES Act, right? And we were just talking about bonus depreciation. So bonus depreciation will very often produce large tax deductions that you can be eligible to take against your ordinary income if you can qualify as a real estate professional. So let's start with some of the basic thought processes. You buy a building, right? $1 million or more, you're going to cost segregation the building. A cost segregation study is a study where an engineer and a CPA take a look at the building and they break it into its component parts so that they can tell your accountant what part of the cost of the building is 5-year property, what's called tangible personal property. Tangible personal property is anything, a really simple definition is anything that I can unscrew, unplug, disconnect, and walk out of the apartment with. Okay, so things like the appliances, kitchen cabinets, decorative lighting, toilets, sinks, cabinets, all of those things qualify, shelving, all those things qualify as 5-year assets. Now, typically, there's also going to be 15-year assets. Those are going to be things outside of the property. Those are going to be things like the parking lot or the driveway, their land improvements, sidewalks, things like that. And you can depreciate those over 15 years, but both 5-year and 15-year property are subject to what's called bonus depreciation, which means that in 2019 and 2020, you're able to take 100% of that cost and deduct it in year 1. And by doing that, what happens is you can create a rather sizable loss on your for your tax return for the first year of the building purchase. So now, let's say, for example, that bonus depreciation loss exceeds the amount of income that I had for this year. And I've got a client right now who has that exact situation. He has about $500,000 of taxable income, and he invested in multiple syndications this year. And he's got over $1 million of bonus depreciation, right? So he's going to actually have a negative taxable income, $500,000 of earned income, less $1 million of bonus depreciation. Now, he can take that bonus depreciation because he qualifies as a real estate professional. In order to qualify as a real estate professional, you have to have at least 750 hours of real estate related business activity that you're doing, either yourself or your spouse, and it has to be more than 50% of what you do. And if you can, and you have to document that. That's where the record keeping comes in. Now, if I can do that, then I can qualify as a real estate professional. And as a real estate professional, I'm allowed to take losses, unlimited amount of losses against my earned income. So now, in this case, my client is a real estate professional. He qualifies. He's got $500,000 of earned income and $1 million loss. So now he has $500,000 that he can carry back according to the new CARES Act law, which allows you to carry back the loss for 5 years. Now, the old law said I had to carry that forward. Okay, so I would have taken my 2019 loss and carried it forward to 2020. Now, with the new CARES Act law, I can carry it back 5 years. So a 2019 loss, I would first carry it back 5 years to 2014. I would wipe out whatever income I had in 2014, and then I would move to 15, then I would move to 16 until I used the entire $500,000. Now, there's some math and some planning that goes into this, right? Because think about this. If I have relatively low income in 2014, 2015, 2016, right? Then when I carry back my loss from 2019, I'm carrying it back to potentially to years where I pay tax at a very low rate, right? Now, let's say I did that. I had low earnings in 2014, 15, 16, but I have much higher earnings in 2020, 2021. Well, I want to make sure that I'm getting the maximum benefit of that tax loss that I want to take. So I don't want to carry it back and recover taxes, get a refund for taxes I paid at 15% in 2014 or 2015, when I could carry it forward and apply it against taxes I owe at 35%. Does that make sense?
Absolutely.
Okay. So when you look at the carryback, you have to do the math in both directions to see which is going to be more beneficial. there's a, so that's one of the bigger things that came out of the CARES Act. If anybody on the call owns commercial property like office buildings, mixed use properties, shopping centers, there was a definition that changed within the tax code for what's called qualified leasehold improvements. Okay, these qualified leasehold improvements, which were going to be 39-year property, now have changed with the CARES Act to be considered 15-year property. And as 15-year property, they are now subject to bonus depreciation, right? So if you own those kind of properties, office buildings, shopping centers, retail, you want to go back and check with your cost segregation study person and potentially your CPA as to whether or not you had those kind of leasehold improvements that would qualify for this new transition from 39-year depreciation to 15-year depreciation. You wouldn't find that in apartment buildings typically.
Hey, Ted, I have a question here.
Yeah,
For
go ahead.
folks who are not real estate professionals, so let's say they are W-2 employees and they have, let's say, stock losses, so whatever from 2020, can they carry that back 5 years as well? Or does it have to be depreciation, or what kind of income or what kind of loss does it have to be?
No, I mean, look, it's whatever loss you have. Now you have to keep in mind that your stock losses, capital losses, are typically capped at $3,000.
Mm-hmm.
So you can't, if you have $1 million capital loss on stocks, you're only getting, you can apply it against other capital gains first, but your max loss on your tax return is $3,000. So you're probably not creating a net operating loss that way, right? But let's say you had a business that like literally, went south and went down, and now you have a huge loss on your business, or you just had a plain old bad year. I've had clients that have literally just had, a horrible year, and they literally didn't make any money, and they've got a $300,000 loss in their business, and that was all of their income, right? Well, they could carry that back to years where they had income and get a refund back for that.
So what is the 2-year carryback versus the 5-year carryback? Because I've heard of that 2-year carryback as well.
Yeah, in this scenario, the new carryback, the one that came out of the CARES Act, is actually a 5-year carryback. I think the 2-year carryback went away when they did the 2018 new tax law. That's an old rule.
Got it.
That's why they got the when they did the CARES Act, they put the carryback back into play, I guess.
So let's say you don't want to carry it back all the way to 2014. You just want 2017 and 18. Can you carry it back like that?
You have to start with 2014.
Got it. And I think there's a question about, what about W-2 people with multifamily depreciation loss? What is the net operating loss carryback? Not a real estate professional.
Yeah, if you're not a real estate professional, you're not going to be able to take all of that bonus depreciation. So you're not going to be able to create a net operating loss. Does that make sense? Because you're limited. If you're a W-2 employee and you're basically a passive investor, the biggest benefit you can get from real estate investing is tax-free cash flow, right? So a passive investor typically gets cash flow from his investments, but his or her investments, but you don't pay any tax on that because the depreciation takes your net real estate income to zero every year and then carries over any real estate losses that you have to the following year until the property's sold. You're literally not allowed to deduct the bonus depreciation losses against your ordinary income because you can't qualify as a professional.
So the depreciation that they have left over for the year cannot just be carried back. Let's say they had previous years, they had real estate income. They can't just apply that depreciation.
No, that's not, you have to be a professional to be able to take the big loss that creates the carryback that allows you to go. Because and you think about it from this standpoint, the reality of what they did with the CARES Act was meant to be a giveaway to really large real estate professionals, developers and building owners, that sort of thing. It wasn't meant for passive investors. It was basically a giveaway to large real estate companies around the country.
So from a W-2 employee standpoint, are there any tax law changes in the CARES Act that impacts them?
Yeah, I mean there's some things that are pretty beneficial. I think you had touched on one at the beginning of of when you were doing the intro, which you were talking about retirement distributions. So let's say I want to take a retirement distribution right now, and I don't want to pay penalty on it. If I can show that I have a COVID-related a problem that I need to take money out of my retirement, I can do that right now. And what ends up happening is I can spread the tax on the ordinary income, the tax on the distribution over 3 years instead of paying for it all at year one. So I can take up to $100,000, and then the tax on that, let's say the tax was 20%, just as an example, no penalty. So I'm only going to pay on my ordinary income rate. The tax is 20%. Let's call it $20,000 on 100. I could pay that $6,667, I guess, a year for 3 years, instead of having to pay the tax all in 1 year. Or if I put the money back by the end of year 3, then I don't have to pay tax on it at all. I would have paid the tax in years 1 and 2 on a third of the distribution in each of the first 2 years. But if I pay it all back by the end of year 3, then I can go back and get refunds for years 1 and 2. So effectively, I've gotten free use of my money for 3 years, and that may not be a bad thing. You could make the argument that hey, my current rentals are down due to COVID. I'm going to take $100,000 distribution, and I'm going to invest that money for 3 years, and then I'm going to put it back. Now I don't have to, so now I got the use of that money outside of my retirement to make some money, and I didn't have to pay taxes or interest on it.
So when will the first set of tax payments be due? That $6,700 you mentioned this year.
It would be due it would be due April 15, 2021.
Okay. Because there was some confusion about it, because earlier they said it was 2023, I think, and then I don't know, that changed a little bit.
Yeah, it's because it was 3 years, right?
Mm-hmm.
So, but you're going to have to pay the tax every year, and then.
Okay.
And then if you put it back by 2023, right, then you're able to go back and get your money back. So it's effectively free.
Got it. I think there's another question about someone becoming a real estate professional in 2019, but had bonus depreciation they could not use in 2018 due to a W-2 job. Does this new rule allow me to go back and capture the depreciation?
Yeah, and you could do that 2 ways, right? So I can go back and I can amend my, so if I had a W-2 job in 2018, the loss carried forward to 2019, and the year that I qualified, now all of that bonus depreciation becomes eligible, right? So that's an important factor that we didn't really talk about. So if I couldn't do it in 2018 because I didn't qualify, right? And then I qualify in 2019, I still have all that carryover from 2018. Now I can take that entire loss in 2019, right? And if it exceeds my current 2019 income, now I have that NOL, that net operating loss. I've created that, right? And now I can go back and recapture, or I can go back and do the carryback and get all of that, I can go back 5 years and get that money back, right? So for 2019, so this creates a strategy for 2019 people who have big depreciation losses, right? But they couldn't take it because they didn't qualify as a real estate professional. Well, now coming into 2020, there's an opportunity that if you can qualify as a real estate professional, or if you can qualify your spouse as a real estate professional, because it works either way, then you're able to take those losses, and then those losses, if they exceed your income for that year and create a net operating loss, can be carried back. So there's a real thought process about, and I consult with people about this all the time. How do I become a real estate professional? How do I qualify? How do I keep the records to make sure that that if I feel like I qualified and I report it that way, and I do the net operating loss carryback, or I wipe out my income, making sure there's a chance that you might get looked at, especially if you're wiping out $500,000, $1 million. That's a lot of money. The IRS may take a look at that, and you want to make sure that you have a bulletproof log that documents not only the amount of real estate time that you spent, but the time you spent doing all of anything else that you do, right? And I'll tell you a quick story. I had a client one time, this goes back a few years, who I knew had a 40-hour-a-week W-2 job, and she was a real estate agent and an investor on the side. And she said, I have some losses. I want to take real estate professional status this year and take advantage of those losses. And I said to her, I said, you're not going to qualify. I said, your job, is going to disqualify you. You work 2,080 hours at a job every year. And she's like, yeah, I know. She's like, but she's like, you don't know me. All I do is work. And I've got, at least 2,081 hours of real estate related stuff. So I qualify. I'm over 750 hours, and it's more than half of what I do, right? And so I said, I don't know, I said, I wouldn't do that. I don't feel comfortable preparing that return. And she's like, okay, well, I'll do it myself. You're fired, and she left, right? And about 2 years later, I get a phone call, and it's her, and she says, I just got a call from this woman from the IRS in New Haven, Connecticut, where, close to where my office is. And she'd like, you and I to come down to my office, to her office, and talk about my real estate professional status. And she says, can you help me with this? And I said, no, I can't help you. You don't need an accountant anymore. You need a lawyer, because I told you didn't qualify, right? And so, it ended up that she went down there and ended up writing a big check for, the taxes she owed. The point being was, if she had had a really good log, that showed that she actually worked, 2,100, 2,100 hours or 2,200 hours, she probably would have gotten away with it, right? But there's probably not a bigger red flag than claiming real estate professional status with a full-time W-2 job. And if you're going to do that, your documentation better be bulletproof.
That makes sense. So there's also this a provision to actually just borrow from your 401k, solo 401k, without actually taking a disbursement, and not really pay taxes, but pay interest, and it's for a longer period of time. So I have a couple who are asking what kind of, if I borrow, should I pay interest? I believe you have to pay interest, and how is that interest determined? And can I use it like a line of credit, like take 10K now and take 50K in September if the situation continues to deteriorate?
Yeah, I mean, it really has to do with how your retirement plan is written and what the loan provisions are. I mean, that could be different for every single person on the call, right? Depending on how they're, what's written into their plan documents. But typically you have an option, like for example, in mine, I have an option that would allow me to take 50% of whatever my balance is, right? Now, could I take that in increments? Absolutely. I believe they established there's an interest rate that they use that's it's based on whatever the prime rate plus some rate of interest is, so that you're paying like a fair. You're not like how you say you're not discounting the interest. You're paying market interest back to yourself, right?
Mm-hmm.
And yeah, applicable federal rate. There you go. And so that works. Now, you probably could, based on your plan documents, maybe you could take 10 now and then add 10 to the loan a little bit later and another 10 a little bit later if you wanted to, right? But that would be based on how your documents are written.
Got it. And another question here is, what do I have to do to become a real estate professional? I think you answered that. If I become one this year for 2020, clocking in 750 hours, it's a little bit more than 750 hours, right? Because if you have a W-2 job, you have to exceed the W-2 job hours. Can I apply bonus depreciation towards past years starting in 2014? If he does become a real estate professional, he can go backwards, right? From 2020 as well.
Yeah, assuming that he has so much loss that it exceeds his, first you have to wipe out your current year income, right? So in my example, I had a guy who had $500,000 of income and $1 million in depreciation loss. So he was gonna wipe out his 2019 income and then carry back the remainder. So it's the same thing in 2020. You first you wipe out your current year's income, and then if you have some left over, that's when you carry it back. And if you do it in 2020, you're actually carrying back to 2015.
Right. And I think there's a follow-up question on this, which is very valid. It's like, what if you're a part-time W-2 person? Can they qualify as a real estate professional if they actually work?
Yeah, no, and I think that's probably the scenario where a lot of people who do qualify with W-2 jobs, that's how they do it, right? Because they have a part-time job, or they have a job that allows them to like people that are in sales, just as an example, right? They may have what is considered a full-time job, but they really don't work full-time, right? So in this case, Ram is saying that he works 1,100 hours. Okay, that's great. So now you have to work at least 1,101 real estate hours, right? And document it. And the other thing that I find, that I like and I find very helpful in proving that is I want to see you make money, right? So because it says running a real estate trade or business, right? So I can qualify as a real estate professional if I'm managing my own portfolio, right? If I'm managing my own portfolio of properties over and above my part-time job, and I spend 1,100 or 1,200 hours managing my properties and 1,100 hours working at my part-time job, I qualify as a real estate professional. If I'm doing real estate agent work or real estate broker work, same thing, I qualify. But I want to show that I'm making money. I think a lot of people have a tendency, especially when they're trying to get their spouse to qualify, they just, they sort of make up these sort of activities, for them that are real estate related, but, and so the hours are valid, but they're not really running a trade or business because, okay, where's the money you made, right? If I worked 1,100 hours and I didn't make $1, am I really running a business? And that's an argument that the IRS will definitely ask you. So it should be a legitimate trade or business. And typically, what I start with a lot of people with is, do you have your own properties? And if you do, let's start self-managing those. Maybe you can find some friends that have some properties, or get some friends involved in real estate investing, manage their properties for them. and now you have this little side business, either managing properties or a combination of being a real estate agent and managing properties, or maybe you're flipping houses that would qualify because that's considered development. You could be in the syndication business, and all of those activities, qualify. But I would want to be making sure that I bought a property, or I had an acquisition fee or something along those lines. I was going to say, I was going to answer the question. It's not based on how many properties you have. It's based on how many hours you actually work on those properties.
Right. So what are the changes did you mention, Ted, for as far as the
There's
CARES
a couple of other things. I have some notes here. We hit on the probably the last one is, if you have a business right now, there's a whole bunch of things related to payroll taxes that you can take advantage of. You can actually get an employee retention credit up to $5,000 per employee for wages that are paid during. In other words, if you have a business and you keep your employees employed during this crisis, then there's a tax credit for that. If you didn't get the PPP loan that basically pays your employees, and you're paying them out of your pocket, then you're entitled to a tax credit for that. That was another provision.
And what is the amount of that tax credit? Because I think you can be self-employed as well as and get that tax credit too, right?
Yeah, it's up to $5,000. It's based on 50% of the amount you paid the employee up to $10,000. So it's $5,000 maximum.
Got it. So a couple of questions about the employee retention credit. I'm not seeing the questions here. While we wait, Shankar asked, if I plan to put my 100K distribution from my solo 401K after 3 years, do I have to express my intent to do so in the tax filings in 2021, 22, and 23?
No, once you put it back in year 3, you go back and amend, and then you show them that you put it back. Because you don't really know whether you're going to put it back in year 3 in theory, right? So you're going to pay the tax on it, a third of the tax in year 1, third of the tax in year 2. And then when you put it back in year 3, you just go back and amend your tax returns to get the money back.
So you do pay taxes and then get the money back?
Yeah, in that scenario with the retirement contribution for sure, yep.
But that's not for the loan. That's only for the disbursement.
That's not for the loan. That's for the distribution, the COVID-19 related distribution, not a loan. The loan you don't pay any taxes on.
Right.
But you pay it back, usually on an amortization schedule, like quarterly or whatever.
Can I apply to salary paid to self and family members? The salary is paid by an S Corp LLC. About the employee retention credit.
Yeah, I mean, look, here's the thing. Were they employees before? Because it's a retention credit. So if you were running a family business and you were paying these people already, then yes. If you're just going to pile a bunch of family members, onto your return that weren't there before, then you're probably not going to qualify, because it's a retention credit. The idea was that they were already working there, and now you're still paying them. You didn't fire any of them as a result of the crisis.
Okay. The second question is, does the employee retention credit apply to Q4 salary if the stay-at-home orders are lifted by then?
There's a certain time period for the employee retention credit. And I'm not sure exactly what it is, but it was from basically the time they passed the act into the summer. I don't believe it goes as far as the fourth quarter, but it's through December 31st, 2020. Okay, that somebody's saying it's through December 31st, 2020. Yeah, then it would apply through the end of the year, which is a good thing. So take advantage of that. And look, nobody knows there's going to be stuff that changes along the way here, right? Because that you may see CARES 2 or CARES 3, come along as this thing progresses, because nobody really knows, how long this is going to go on. And yes, you cannot double dip. You can't use PPP money to pay your employees and take the employee retention credit. The employee retention credit is only for employees you funded out of your operations, out of your pocket.
So
But
what happened?
here's another interesting thing though, right? So right now there's talk going on in Congress, because the money that you were given in the PPP, right? Even though that money is it's a loan, it's not taxable, right? The deductions, the money you take, and then you pay payroll on it. That payroll right now is not actually tax deductible to you, right? Because you you don't have to pay as if it's not tax deductible to you if the loan is forgiven, right? So you're not going to double dip. But right now they're talking about in Congress about allowing small businesses to double dip on it. In other words, take the money, it's forgivable, they don't have to give it back, and they can deduct the actual salary expense and utilities and whatever else you're paying with it, right? But that is not the law right this minute. But that may be that when I say there's changes coming down, that may be one of the changes that you see, that you're literally going to be allowed to take the free money in essence and then actually deduct the actual salary that you paid with it also.
Okay, this is a different question here on a different track here. I once heard a deal sponsor that was a CPA saying that she never did bonus depreciation as she didn't want to impact her investors. What are the downsides of using bonus depreciation? I don't understand why she wouldn't use it.
If I
I
if
mean, there
I
could be
was in a deal,
recapture
right?
on that.
Yeah, but think about it from this standpoint. Most of the time when you're using bonus depreciation, right? The bonus depreciation only really has value to the operators, right? Because typically the passive people, the limited partners, are going to have a more limited opportunity. They would have to qualify as real estate professionals in order to be able to use the bonus depreciation. So typically, the bonus depreciation is for the operators. Let's put it that way. Now, if I'm an operator who, let's say I'm the operator, I'm a CPA, I don't qualify as a real estate professional, right? Well, then and all my partners are CPAs and they don't qualify either, right? So I'm the general partner, but we set up the syndication. If I don't need the bonus depreciation, I'm probably not going to take it, right? Because why would I pay for the cost segregation study, $5,000, $6,000, $7,000, $10,000, depending on the size of the building, if I wasn't going to get the tax benefit back? So there's a lot of times where people ask me, hey, should I do a cost segregation study? And the first question I ask is, well, are you a real estate professional, or are you and your partner's real estate professional? Because if you're not, then there's no point really in, you're not getting any bang for your buck by doing the cost segregation study. And if you don't do the cost segregation study, then you don't get the bonus depreciation. Does that make sense?
Right. But doesn't it also still offset your passive income from the property? Let's say your cash
From
receipt.
others, yeah. But
Yeah.
typically the regular depreciation, at least in the first couple of years of a property, most properties, just the ordinary depreciation, because you've got, think about, when you buy an apartment building, right? The first few years, it's those first few years, your interest is as high, your interest expense is as high as it's ever going to be, because you're just at the beginning of the loan payment
Mhm.
phase, right? And then you still have the ordinary depreciation, which is probably usually a pretty sizable number. It's usually between the interest and the depreciation, it's usually sizable enough to basically offset net operating income for probably the first 2 to 3 years of the property
Got it.
on average, right?
Does running a management company, not property management, that manages the deal finding, performs the deal analysis, and advises another company as to which multifamily syndication to invest in count as a qualified real estate professional activity?
Probably, yeah. If you're making money doing it, yeah. Yeah, you could make that argument. I'd want to know. I mean, that would be. What I would do is I would tell you, like we were talking about at the beginning. You know, this is all general advice, and you should really run the specifics by someone. You know, but it probably does, and I would want to get a little more specific on exactly what you're doing.
Okay. Another question here. Can you take the 401k per the CARES Act and use it for real estate investments or in other business investments or in stock and put it back in 3 years with no penalty? I believe the answer is yes, but I'll let you
Yeah,
answer.
yeah. I mean, you're gonna pay the tax in years 1 and 2, a third of the tax on the distribution in years 1 and 2, and then when you put it back in year 3, then you go back and amend the returns and get the money back. Yeah, that's effectively what you've done. You've basically effectively used the money to make an investment, and then basically it was both tax and interest free.
So wouldn't you actually just take a loan initially and then do a distribution instead of the other way around? Because with a loan, you don't have to actually pay taxes. So you can actually use the loan and just pay an interest rate. And then maybe if you need more money, you can then dip in as a distribution.
Yeah, you could do that too. Exactly right. I mean, look, the distribution amount is up to $100,000. If I'm sitting with $100,000 in my 401k, for example, or IRA, if I've rolled it over, whatever, I can I can I can take that distribution because it may be, if I want 100,000 and I have 100,000, then I can take the distribution. Whereas the loan feature may only allow you to borrow a third or half or whatever. But you're right. You could take the first half as a loan and take the rest as a distribution. It all depends on when you want to pay it back, because on a loan, you're probably making quarterly payments at least. Whereas with the distribution, you literally can put the whole lump sum back at the end of year 3 and never make a payment in between. So it's specific to which way is better is specific to what you're trying to accomplish, and it would be different for everybody depending on what they're trying to do. Does that make sense?
Makes sense. Yep. And the follow-up question on this is, if you have gains from the investment that you made with your 401k dollars, the distribution, then you do have to pay taxes on that. Yes, of course, it's outside your
Yes, because it's outside, but yeah, because it's ordinary income. It's portfolio income or passive income to you at that point. Yeah. I mean, I guess if it was real estate and you could make cash flow and the depreciation wiped it out, then yeah, in theory you wouldn't do that. You wouldn't pay tax on that because it's the same process as if you invested just with your earned money. You get in a real estate investment, the whole idea is to get tax-free cash flow.
So I have a question. Let's say a lot of people employ their children and pay them, let's say 6,000 or 12,000 a year. And I've heard that you can actually deduct. I mean, you could get up to 12,200 for a child and not have to even file taxes because of the standard deduction. So what is the best way for folks to pay their own children if the children are genuinely helping them in their business, of course? What do you recommend?
Yeah, I mean, I think that's the first criteria. The children are generally are helping them, and if they're doing that, and you want to pay, an appropriate wage, right? You want to pay them, so you don't want to pay them $100 an hour for something that, if you had an ordinary employee doing that, you would pay them $10 an hour, right? So you want to make sure that that you're paying them market wage. Let's put it that way, right? You don't want to go bananas with that, right? But yeah, I mean, you're perfectly entitled to employ your children just like any other employee, as long as you deal with them sort of at an arm's length kind of way, as if they were any other employee. It's a good strategy. And again, it's specific to what you're doing. So I would tell you, go get some, have a CPA look at your specific situation, right? But I'll just give you an
Sure.
example. I used to use my daughter in my marketing all the time, and I paid her like a marketing fee, for doing that when she was a little kid, because we used to do these little. Hey, my dad says he can help you save thousands on taxes. That sort of thing. It's cute.
Yeah, I'm using my daughter for my business as well. So I want to make sure I use it, but I'm not sure whether I should make her an employee or keep her as an independent contractor. So I've been.
No, I mean, it depends on how old she is, right? Because there's a certain, under a certain age, you don't have to pay the Social Security and Medicare.
Mm-hmm.
Right?
And what age is
older. I think it's either under 16 or under 18. I'm not sure. I would look that one up.
So it actually helps. She's 15, so I think she wouldn't have to pay FICA.
She wouldn't have to pay that. I know it's under 16. I know. I'm not sure whether it goes up to 18 or not.
Got it. There's another question here. If I take a loan from my solo 401k, does that show up on my overall debt, impacting my debt to income ratios?
If I take a loan from my 401k.
I don't think so. It doesn't sound like it's a lender there, right?
Well, look, is it, if you're asking me if it's going to show up on your credit report, right? And a bank, then if you turn around and go to a bank later and they just look at your credit report, would they see it? No, probably not. But if they ask you to fill out a loan application and they ask you to list all other loans and you don't put it on there, then you effectively have omitted it, so you may have perjured yourself on the form, essentially. It shouldn't. It would affect your debt ratios if you reported everything honestly when you filled out the loan application. Yeah.
So what's the maximum I can pay my child per year? What's the best way to best retirement account to create? Is it Roth, solo 401k, or QRP?
That's a good question. It really has to do with like what you're trying to accomplish, right? So I can make an argument either way. I would tell you, look, a child is going to get a single child is going to get a $12,000 this year. They're going to get a $12,200 standard deduction, right? Okay. Now, so that means if I wanted to put $6,000 away in an IRA for them, I could literally pay them $18,200. $6,000 goes into the IRA. The other $12,200 gets covered by the standard deduction, and they owe zero taxable income, right? So they pay no tax, right? Now, which is better? So in that scenario, I'm using a $6,000 deductible traditional IRA because I'm going to pay them and deduct it, right? The IRA deduction. Now, but that IRA that I took the tax deduction on, I'm now they're going to have that money in theory until they're in their 50s or 60s, right? It's going to grow tax-free. And when they pull the money out, they're going to have to pay tax on it, right? And typically what you're going to see is they saved at 0%. And now they're probably going to get taxed 50 years later at 15, 20, 25%, whatever. if I use the Roth, I didn't get the tax deduction on the $6,000, but I don't have to pay the tax when I take it out years from now, right? So, and whatever tax they do pay on that is going to be minimal. It's going to be, at 10% or 15%. 15% would be the highest. So I probably would go with the Roth at that point and have it non-deductible, because more than likely the tax is going to be, the tax savings now is going to be a lot less than you're going to pay tax at probably a higher rate 50 years from now. But that, it can go either way, and I can make an argument in either direction.
Right. And the other thing is they can dip into the Roth up to the extent of the contributions for college or any other emergencies they might have, but they can't really dip into the traditional.
No, right. Yeah. And that's another, I mean, more about some of the intricacies of the actual plan, things that you can do with them, but that's a good point. Yeah. Why not? I like Roth. The other thing that you can do is down the road, if you wanted to self-direct it, a guy said to me the other day, he's like, I have a ton of money in a Roth IRA, right? Could I use that for an angel investment, right?
Mm-hmm.
Could you imagine like literally hitting the lottery with your Roth IRA? You throw $10,000 into a startup and it turns into the next Facebook, right? And then you've made millions and millions and millions of dollars, and none of it's taxable inside your IRA.
Tax-free?
I mean,
that's awesome. So Shankar
yeah,
asked, if
right?
we pay 12,200, that's great. So Shankar asked, if we pay 12,200, do I have to do a 1099 for my child? Can I deduct it from my business? Does the child have to pay taxes on 12,200, or is it below standard deduction?
No, they don't have to pay taxes, but I would make them an actual employee. And if they're under 16, they don't have to pay the Social Security and Medicare, but you would actually run it through payroll and give them a W-2 as opposed to doing the 1099. If they get the 1099, they're going to have to pay the FICA and Medicare. They're going to pay the self-employment tax on it because they're running a business at that point. What you're really saying when you give somebody a 1099 is that they're an independent contractor and they're their own business. And frankly, you might even get in trouble with, depending on what state you live in and what the Department of Labor laws are relative to employee versus independent contractor. I know in the state of Connecticut and in a lot of states that they would call that, they would say, hey, you're an employee. They're an employee. They're not an independent contractor. We want our unemployment tax every year. So I think if you're going to pay your kids, pay them as employees. What's that?
So can you actually go back in that case and generate payroll for them? Let's say you didn't, you paid them, but you didn't really generate payroll because you are planning to do a 1099. But can you go backwards to 2019 and generate, put them down as employees, or is it more, can it be retroactive?
Well, yeah, but you've got a bunch of forms that you have to fill out.
Mm-hmm.
And if you withheld from their checks, you probably owe some, if you took the federal and state withholding out of their checks, you might not have a state withholding problem in Texas, but other places you might. Yeah, I mean, in theory you could, but you'd have to go back file all the forms.
Right. So I have a solo 401k, so I cannot have a full-time employee. So can my child be a part-time employee and be paid 12,000 as a W-2?
Yeah, depends on what your plan says too, right? Because in a lot of cases, the plans, if the plan was written in such a way as to say, nobody else can join. Nobody else can join the plan because some plans, it's a solo 401k, so it's probably just written just for you. But there are 401k plans where you can have, they're written in such a way that a person cannot be eligible for the 401k until they put in a certain service amount. You get to define that. Part-time employee probably wouldn't blow up your 401k, your solo 401k, but that would be a conversation that I would have with my 401k custodian, whoever's running it, to make sure that you're in compliance with the terms of your retirement plan document.
And is there a minimum age for a child to get paid?
No, as long as they're doing the legitimate work. I was paying my daughter when she was like 6 or 7, and but she was doing legitimate, she was doing legitimate stuff, you know.
Okay.
I wasn't trying to max it out. She was getting a little bit of money. I wasn't trying to hit 20,000 or 12,000 or anything. It was a few $1,000.
Any other questions from the audience today? Ted, is there anything else you want to share with us? Anything else we should know about?
The last thing would just be to, you can get my book, The Tax Smart Landlord, on my website, www.lanzarocpa.com. You can get a digital version for free on the website. And it's 39 really great tax strategies for real estate investors. And if you're interested, there's other resources on the website. There's webinars and other articles and some other videos and stuff that I've done that talk about tax strategies. So that all that's free. You can go and just check it out. And if you want to talk to me about your situation, you can schedule an appointment there, or you can email me at ted@lanzarocpa.com. That's LANZAROCPA.com. And I'm happy to get back to you. We can talk about your situation.
Perfect. And I think I did post the website link in the chat box for folks who need it. If you scroll to the bottom of the link, I just went there. There is a link to downloading the book.
Yeah.
Okay.
Yeah, you can totally get the book, and it's got some good stuff, and it's got some bonus material too. So when you sign up for the book, you then subsequently get like maybe 3 or 4 emails that have little presents in them, little surprises in each one.
Thank you. Thank you so much, Ted. So anyway, I want to close now. Thank you again, Ted, for sharing all this information for us. I know that I have a lot of action items to take away from this. So I appreciate you taking the time to talk to all of us and getting through all the questions. Someone asked, do you offer a complimentary consult for business and personal?
Typically what I'll do is I will have like an intro call with people, maybe 15 minutes, talk about your situation, and then I'll tell you a little bit about my practice. And then ultimately, if we feel like it's a match, then we can kind of move forward with, whatever we think is the right course of action to take. So yeah, I mean, I'm happy to have a short call with anybody and learn more about what they're doing, tell them how I think I can help them, what the cost involved would be, that sort of thing. And everything we do at my firm is flat fee, quoted in advance, no surprises, no hourly rates. I don't charge for 5-minute calls. So if we're going to work together, I basically say, look, this is what I'm going to do for you. This is why I'm going to do it, how it benefits you, and what the cost is going to be, all in advance.
That's great. We appreciate that. Thank you all for joining these webinars and taking time away from your families to come learn with our amazing guest speakers like Ted. I hope to see a lot of you on Sunday at 5 p.m. Central for our next webinar on infinity banking with life insurance, to learn how you can take advantage of reliable and safe savings vehicle that's been around for more than 100 years. Life insurance allows you to create your own bank, providing a high yield on your capital without the risks of being exposed to the volatile stock market or the unknowns of most investments in these uncertain times. So I hope to see you guys there on Sunday at 5 p.m. Thank you everyone for joining, and thank you so much, Ted, for joining.
Thank